Will. All right, we are live. Haven't done one of these in a little while. All right, let's see. We got everything set up. Everybody hear me? Okay. Hello. How are you? My name's Ryan. I'm a mortgage nerd. I do business in Utah and Nevada. My office is located in southern Utah, St. George, Utah. Absolutely love this part of the state. Love this area. We're about maybe 2 hours north of Vegas on the I-15 corridor. And we're about 350 miles or so south of Salt Lake City. So we're kind of on that corridor route between Salt Lake City and Las Vegas. And I wanted to jump on here and just answer some questions that have been submitted. If you have questions, you can add them to the chat. I can get to those. Just any questions you have. Let's see how this is. Let's just haven't done one of these live ones in a video, so let's do it. The first question I see, and it's coming up a little bit more often, is when should I refinance? Let me make sure. Gotta look under my camera here. Gotta see my screen. I hope everybody can hear me. Can you hear me? Let's see. Mute. All right. I hope it's working. I can see me on the screen. I just can't really tell if you can hear me. So I really hope you can hear me. Well, all right. If you can't, please comment. Maybe when I post this later, or when it goes on to YouTube, maybe I'll just see me talking to nobody or whatever. All right. So here's the question that I'm getting a lot more often is interest rates have started to lower a little bit. There's some consensus that the Fed might actually be able to back off their interest policy, maybe a lower interest rates here at the last of the year, maybe the first of next year. That when is a good time to refinance? When should you actually look at refinancing? A couple questions when I have that come across my desk when a client calls me about refinancing is how long do you plan on keeping the home? If it's a long-term home, that's where it makes a little more sense to refinance without necessarily a full point reduction. There's always this talk that if you get a 1% reduction, that's when it makes sense. But that was when interest rates and home values were 100,000 or 150,000. When they're a lot more now, you don't need a full point reduction to refinance. It does come down to how long you plan on keeping the home. If you're only going to keep it for a few more years, the cost you're incurring to do the refinance may not offset the payment you're going to get without seeing a bigger reduction in the interest rate. But what I'm seeing a lot of people able to do right now is not only lower their interest rate a little bit, but also remove the mortgage insurance. So if you have a loan that you did maybe a year ago, 2 years ago, 3 years ago, whenever you purchased your home and it had mortgage insurance, you may be able to remove it by either having enough equity or you can pay a one-time fee and remove the mortgage insurance from the life of the loan. And that fee can be anywhere between 1% to 2% of the loan. I've seen maybe even a little lower, depending on that loan to value, depending on your credit scores. But it's a great way to not only lower the interest rate, but also remove that monthly mortgage insurance premium. And honestly, even if the rate stays the same or really close, removing the mortgage insurance actually goes a lot further than even rate reduction in some cases. I will say that most people are right on the edge of refinance. We saw a little uptick as we got rates kind of dipping into that maybe upper fives, upper sixes or lower sixes, like right on that edge. And then they kind of bounced up just a little bit. So we did see an uptick of applications for maybe a week, and then it kind of slowed down a little bit. But it's on the back of people's minds that have purchased in the last few years that they may be able to save on their interest rate, especially the peak where the rates were the highest in October of about 2022. So right around there, if you purchased a home in that last quarter of 2022, kind of the first part of 2023, this is where you'll see some benefit of being able to refinance. And refinance is essentially just taking a new loan and replacing the loan that you have. It doesn't have to be with your current lender. And in fact, a lot of times the servicing gets sold or transferred. So you may not even have done your loan with the company that now has your loan. So staying with them isn't necessarily a huge benefit. And using the lender that started your loan or somebody like me that can start fresh can actually be a lot of benefit because we're following the same guidelines of the servicing. It's not like they're getting better rates and terms than what we would get. If you have an FHA loan, you can look at streamline options. So there is a few things that are out there. But if you want a free review, there's no cost or obligation. Go to my website at ryanbolton.com. Call my office. I can just run through some numbers, what your new payment might be, all those fun things, and see if it is time to refinance. But I think it's on the edge. For most people, it's right on that edge, depending on when they bought the home and depending on if they have mortgage insurance, how long they plan on keeping the home. These are all things that I review with a client to make sure it makes sense. So check out Ryan Bolton, Bolton, ryanbolton.com, and you can call me or set up an appointment or apply right there, whatever you want to do, or give me a call and we can kind of work through it. See if there's any comments in the chat. Okay. I'm hoping my voice is on this because I can't see if it's recording my voice. I don't know. All right. I'm new to the live. I've done a lot of the videos on my YouTube channel, but I haven't done a lot of lives. But just thought it'd be fun to jump on here and see what happens. If the phone rings, I'm just going to answer it. I mean, this is just how it works. So they'll just see how that works. Okay. All right. Let's see what the next question is. Let's see. Is it possible to obtain a home loan for buying a home if you're not currently employed? No. We have requirements that you have to show your ability to repay the loan. So you at least need to be employed. Now, you don't have to be employed necessarily a full 2 years. You can just start a new job depending on how you're paid. So it isn't something where you have to wait 2 years at a job to be able to get a new home loan. But if you're currently not employed and we can't show you're going to make the payment, you're not getting a loan. Now, there are some loans that allow for different type of income verification, like rental income, other type of income where you may not be employed, but you still have to show you have some sort of cash flow, some sort of money coming in to be able to qualify for a home loan. It also will change how much money you have to put down if you need to use a program that is, there's really not stated income loans. There's a couple that are getting pretty close. And those are still more designed for non-owner occupied investment properties, not for really a primary residence. But they are starting to kind of come back in some waves. If there's enough money down, the credit scores are high enough. And I think those are valuable products. I think it's if it's a make sense deal and they're putting enough money down, the credit scores are there, their income is made from different sources like rental income, that kind of thing, and they're not really actually employed, but either self-employed or W-2 and pay stub, there still should be loan options if it makes sense. The problem in 08, it just got completely abused. So now there's a lot more laws that are protecting these types of things from happening again with ability to repay and some other qualifications we have to do. So obviously it's a one sentence question. So it's going to not have all the reason why they're asking that question, but generally you have to be at least employed, self-employed, income has to be coming in. We have to verify your ability to pay back the loan with the debt ratio, with an expenses. How are you paying your car payment? How are you paying the other payments if you add a new mortgage debt on here if you're not employed? But there's people that are self-employed, people that have rental income, people that are living on retirement, that type of thing where they're not necessarily employed, but they are earning an income. Income is coming in. So that's what we have to verify, especially for the lower interest rates. If you don't have these and want to put the extra money down and go off of some of these other programs, the rate's going to be higher, down payments are going to be higher, but there may be options if you're not actually employed, if other income is coming in. If no income is coming in any way, shape, or form, I don't know any lender right now that's going to loan money to somebody that's not even having any kind of income coming in. So I hope that answers that question. That one's like I said, it's a one sentence question, but there's a lot to unpack there. Let's see. Any questions? You can post them in the chat, in the comments. Love to answer any questions I have. Let's see if there's a way to. Okay. All right. Let's see. What other condition does it make financial sense to refinance a 30-year fix? So that's a common one popping up as interest rates have dropped and people are kind of thinking about refinancing, that we're going to see a little uptick in that when refinances have been dead, absolutely dead for like 2-3 years because most people had a lower rate than what was available. And as people buying in this cycle, they're now the ones that can take advantage of lower rates, where there's still people that bought 5 years ago, 6 years ago that won't need to probably ever refinance unless they're selling and trying to free up some money or do a home equity line of credit or something like that. Or it's going to be very rare, I think, for refinances in a certain wave. But of the last couple of years, it's starting to make sense. It's getting closer for many people, and it's worth running the numbers. And that's where I can do it for free for you if you're looking at a refinance. Here's what are the disadvantages and advantages of using a home equity line of credit instead of refinancing your mortgage. So two different terms here a little bit. A home equity line of credit is typically a second mortgage. So you have your existing first mortgage that you used to buy the house or refinance or whatever. You have a first mortgage. A home equity line of credit is typically a second mortgage. It's a separate loan. So you don't refinance the first. You leave it alone at your 2, 3, 4, 5% interest rate, and you just add a line of credit or a second mortgage. The benefit there is it's usually a loan you can pay back, use, pay back. It's usually a better interest rate than credit cards or any other type of debt out there. And you don't have to refinance your existing first mortgage if you have a better rate than what's in the market. Now, if you don't have a first mortgage and you just want to get a line of credit on a free and clear property, you can do that as well. But typically in that situation, a new first mortgage will have better rates and terms 30-year fixed money, cheaper interest rates typically than a home equity line of credit. But with a home equity line of credit, it has that draw feature, very much like a Visa that's just secured against the home. So it gives you collateral for the lender. So the rates and terms are usually going to be better when you can put up some sort of collateral, especially a home. So they're two different things there a little bit. But a lot of it, I will tell people that if they're thinking about adding a second mortgage and they do have a higher rate on their first, they may want to refinance the first, make sure it's the best terms you can get, then add the line of credit to do home improvements or pay off other debts or whatever you might be doing. So again, one sentence question here. The wording might be a little bit different than what the phrasing actually means. And it's worth having those conversations with a licensed loan officer in your state. I can do Utah and Nevada. Love to earn your business, show you what is available to you, and run these scenarios to make sure that you're using the right terminology and what is the best loan option for you. Let's see. How does an economic downturn impact mortgage rates? Mortgage rates are tied a lot to the bond market, so it kind of depends on what's happening within the bond market. But it's funny, when the economy is doing really well, money flows more to stocks, which is away from the safer bond market or the lower interest rates that are offered on the bond market if the economy is doing really well. So actually mortgage rates in a lot of ways go up when the market's doing really well. Mortgage rates go down when people are finding other places to put their money, not in stocks, bonds, stuff like that. So they end up putting more money into bonds. So almost it's kind of a counter thing. When the market's doing well, rates do higher. They usually go higher. Now we've seen inflation play a different role in that. And that's why we've seen the cost of money go up because of inflationary pressures, and that are just rapid. I mean, just such a rapid increase in the inflation numbers that's what had to slow down the creation of new money by raising interest rates. So there's more than just a general rule of thumb there, but generally, if the inflation numbers are kind of where they want it and there is an economic downturn, that usually actually makes rates better in the past because people are moving away from stocks that are more risky or scarier and into something what is considered more of a safe haven with going into the bond market, which is what the mortgage-backed security market's tied to. Now, if it goes totally crash or totally one way or the other, where there's an extreme, things are different. But normal markets, kind of normal up and down ebbs and flows, that's what you're going to see within the mortgage market. What else we got? Any live questions? You can comment in the chat. If there's any live questions, anybody watching, any questions you have, I'm here to answer anything you got. All right, let's see what else we got. Is it wise to use a credit card 0% interest to make a large payment towards a mortgage? I don't know about wise. I mean, it's still a credit card. The introductory period is usually a short period of time. I've seen some getting out to like 18 months. So sometimes they're a pretty long introductory interest rate. But I would say the most are 6 months, maybe a year. So if you're pulling out 20 or 30 grand or something for a down payment on a house and you have that much time you just got to make sure you can pay off that introductory rate within that time frame. And you want to look at the terms of that credit card, because if it's zero interest for 12 months and you go past the 12 months, sometimes the interest is retroactive. So all of a sudden they're catching up a year's worth of interest and adding it to the loan. So you want to know what is the catch or how long is it good for, and just make sure that you pay, if it's 10 grand, you have 20 months or something, you want to make sure you're making a payment to have it paid off within that introductory period. But just be aware that sometimes it's not 0% interest forever. Usually it's an introductory rate of some kind. And usually there's some sort of interest reserve or going back and collecting the interest of the free time that the money was out. And I guarantee the interest rate after the introductory period is going to be worse than the mortgage interest. So then all of a sudden now you've got a much higher interest rate on the debt that you've acquired to get into the home. I still think it's worth getting a home if it makes sense. It just, you got to look at the terms of that that 0% credit card. You got to know the terms of that to know what you're getting into, and just know, okay, I've got to pay this thing off in 6 months, 12 months, 18 months, whatever that 0% interest time frame is. And you want to add that essentially to like your mortgage payment, make sure that payment is dropping down that credit card balance. You just don't want to have that balance sitting there 0% for 6 months, 12 months, 50 grand, 20 grand, whatever it is. And then bam, all of a sudden now you've got a 14, 20% interest rate on a credit card on that debt. So is it wise? It can be, depending on if you know what it is to pay it off. And it is at least zero interest during that time if you're able to pay it off in that window. All right, what else we got? What were the options for refinancing an FHA loan after the market crashed? What were the options of refinance? So they still have a streamline option. That's probably the most common one here, is they allow you to go off your original approval with FHA and just lower the effective interest rate on the note even carry the same term. I know sometimes they will let you go back up to a 30-year term on these. So the streamline was something that FHA offered. And the benefit with that is it didn't require like a new appraisal, new income, new assets, as long as you hadn't missed any payments. I mean, there's still some underwriting guidelines with it, but essentially it's like, okay, you're approved, you're making your payment, rates are lower, you can lower your interest rate. It doesn't get rid of the mortgage insurance, so you still have to have the mortgage insurance. So if you have enough loan to value or enough equity, and you don't have to have 20%, you could have as little as 10% equity. You can pay a one-time fee and remove the mortgage insurance. So it really would come down to the current value as much as the market crashing and obviously what the interest rates are. That makes sense whether you do a streamline with FHA or whether just do a whole new FHA or a whole new conventional loan. But I would say more times than not, when I'm looking at a client that has an FHA loan, more often we're going to put them into a new conventional loan because they have enough equity, the payment drops further, they can adjust or get rid of the mortgage insurance. A lot of it will be depending on the loan to value, depending on credit, depending on time on the job. I mean, there's some factors into that, but I think most of the time you want to get from the FHA to a conventional because the terms in a lot of ways will be better after you've owned the home for 2 or 3 years. And that's where the conventional loan is going to be a better loan in many cases. Can I refinance 175,000 and I took out from my equity? Yes. So any liens against the property can be refinanced, whether you refinance just the first, just the second. A lot of times when you have a first and second, you're usually combining those two loans into a new refinance. A lot of it's just going to come down to credit score, debt ratio, and loan to value. So what the home's currently worth versus what loans are against the property. If that meets the threshold of loan to value, then you'll be able to refinance, put them both together. So a lot of it's going to come down to what the home is currently worth. That'll determine if it makes sense, if you have to bring money in or just have it all into one new loan or just refinance the second. A lot of different ways you can get it done there, but most of it is going to come down to what the current value of the home is. Let's see. Let's see. This was just 9 hours ago. Interesting. Okay. Is it still beneficial to have a lot of cash with the current low interest rates? So I still think I'm a big believer that you're better off to hold on to your cash, depending on debt servicing, debt ratio, things like that, because the only way you get money back on putting money down on a home or having is selling or refinancing the home. So it locks up that money, kind of locks up the equity without those two ways of getting to it. So if you have the cash and you're cash flowing and you can use that cash to make the payment instead of just lump summing the whole thing onto the mortgage, I think in many cases when I sit down with clients, they are better off keeping their cash because you can have access to it. You don't need another loan. You can kind of self-bank. You can pay off other debts that may have a higher interest rate, or if something happens with the car or breakdowns or anything, getting to cash is going to always be easier. At the same time, I think you should make sure that cash is doing some sort of working for you. It's in accounts that are earning interest. It's doing something to offset interest payments that you're making. But in most cases, I think having cash is more important than a bunch of equity you can't get to without selling or refinancing the home. Especially if you have a situation where you're older and husband passes away and the wife hasn't worked, she has no income, no asset, no credit. She has all this equity and can't do a loan. So I've seen so many situations like that where they're equity rich, cash poor. I think you're better off to make sure you have a balance, and having cash is always going to be better. Yeah, I very rarely am going to see somebody who says, I'd rather have all kinds of equity and no cash in the bank. You definitely want to have some of that cash for emergencies, for life happens, for just so you don't have to use other loans. You don't have to do another loan. You don't have to be using credit cards and other higher debt type things if something pops up. So I think having cash is really important. All right, let's see. Any questions live? You can put them in the chat there if there's anything live. All right, let's see what else we got. See if I can refresh my screen and find some more. We are live, people. Are there special mortgage rates for first-time home buyers? Not necessarily. There's really not different rates for first-time home buyers. There's more different programs that are available that may not be available if they weren't first-time home buyers. But one other thing to consider, if you haven't owned a home in the last 36 months or 3 years, you are now a first-time home buyer again. Even if you've owned 100 homes in your entire lifetime, but for some reason, if you moved to an area or retired and been renting and now you want to purchase a home and you haven't owned a home in the last 36 months, you are now reclassified as a first-time home buyer. It's really not difference in interest rate so much. It's more about what programs are available, what underwriting guidelines are a little bit different. Credit score requirements can be a little different. You see a little different leniency in job history that might be shorter, maybe school and then going into the job field. So the job history might be a little bit different. So those are really the bigger differences you see with first-time home buyers. It's not like, okay, the guy with a 900 credit score putting 20% down gets a worse rate than somebody that's never owned a home before because they're first-time home buyers. And it's really not a rate thing as much. It's much more of just guidelines that help people that haven't owned a home before to get into the home for the first time. But that word gets tossed around like crazy. I mean, first time is like ever. I think of first time I was on a motorcycle, first time I had ice cream. I mean, that's the first time. But with first time home buyers, the way it's set apart is it is 36 months, 3 years if you haven't owned a home, if you had bankruptcy or went into foreclosure, something like that, and you haven't owned a home for that time frame, you can rebuy a home. You're reclassified as a first time home buyer. If you went through a divorce, I've seen that where somebody goes through a divorce, they have to rent a home for a while. Now they're wanting to buy a home. It's been 5 years, 3 years, 10 years, whatever it is. They are reclassified as a first time home buyer. So just remember that when you're shopping for a loan. How do you determine mortgage payments? Well, you've got the principal and interest on the loan itself, just like a car loan, like any other loan. You've got the principal, interest, term, and you determine the monthly payment. But with most mortgages, you're going to also have mortgage insurance. If you put less than 20% down, that you have to add to your payment. You're going to have homeowner's insurance, which is typically escrowed, meaning that you collect the first year premium at closing. You make 12 mortgage payments. When it comes time to renew, it's already factored into your payment and gets covered every year. And then property taxes. So here in Utah, the taxes are due every November. So it's very common for escrow accounts in Utah because it's once a month, right around the holidays. It's usually just better to take that payment, divide it by 12 months, and add that to your payment. There's no fee for that, but they collect the interest. So all these escrow accounts have all this money just kind of sitting in the accounts, ready to renew the insurance, ready to renew the taxes, and they make the interest on the money just sitting in these escrow accounts for the whole year. You can manage it on your own. But the risk of foreclosure and the risk of missing the payment goes really up in those situations. And usually most people will just opt for the escrow account. One other thing to consider, if you see your payment dramatically change year over year, or you get a notice that your payment shot up, in most cases, it has something to do with the escrow account. Maybe the property taxes went from a second home to a primary residence or changed in some way that they jumped really up. You can get those things fixed by just finding out that most of the time it has something to do with the escrow account. Very rarely is the interest rate or something with the loan. It has more to do with the escrow account or the taxes and insurance. But that's what constitutes a mortgage payment. Principal and interest on the loan itself, mortgage insurance, taxes, insurance. If you have an HOA, that's usually a monthly bill separate that you pay. That's usually not escrow because it's a monthly bill, where taxes and insurance are usually a yearly or quarterly in case of taxes sometimes. So depends on the state you're in on the property taxes, but it is something where a lot of times those things are escrowed. So when you make your mortgage payment, it's all covered. You don't have to worry about other than that HOA, monthly HOA payment. All right, let's see if there's anything else going on here. How long have we been here? Where's the timer? I'm very new to the live. I haven't done it for, there it is, 22 minutes. So I was going to go for a little while, see if anybody wants to jump on and ask any questions. I really do have a lot of fun posting this stuff. I don't even know if anybody's even found me. So that's part of the problem too, is I might need to just post that I'm on live right now too. I'm really new to this YouTube channel, podcasting, and I've really had a lot of fun kind of learning a new skill, trying to put myself out there. I like answering these questions off the cuff. I don't pre-screen them. I just answer them. And I'm doing this a long time. And sometimes come back. Okay. Let's see if there's anything else that I can do. Okay. All right. Let's see if we can answer more questions. How much of a down payment is required for an FHA loan? In most cases, depending on credit score, it's 3.5% of the sales price. So that's what would be the down payment. Now, a lot of FHA loans piggyback with a down payment assistance program or a second mortgage or some sort of assistance for that 3.5%. If you have a lower credit score, it can bump up as much as 10% down. But I would say, I could look it up, but it's got to be a huge percentage of FHA loans are either 3.5% down or zero. because of the seconds or the down payment assistance programs that are out there. But short answer to that question, 3.5%. I know it's weird to be 3.5%. That's what it's been forever. I think my whole career it's been 3.5%. And it's just the number that they've come up with. There is a couple other programs called Home Ready and Home Possible that require 3% down, but they generally require a higher credit score than what FHA requires. And the mortgage insurance is tiered based on credit score as well. With FHA, you get the same mortgage insurance regardless. So if you have a higher credit score, you might look at these other programs that do offer a little break on the mortgage insurance. But they also have some restrictions on income, how much you can make in a certain county to qualify for those programs. But that's part of my job, is to sit down with the client and say, looks like you might be better suited for Home Possible, Home Ready, or FHA, or it might be better to put more money down or 100% financing. That's all part of my job, is to review what they qualify for and which might be the better loan. And sometimes it's not the lowest interest rate that's the best loan. There may be other programs that actually open up, paying off other debts or paying off other bills, financing a little bit more on purchasing the home, but then get rid of other payments that might give you a little more buying power, which then you'll be able to get in the home you want, have maybe a cheaper overall budget than just putting the money down on the house. So that's part of my job, is to review all that. Same with putting 20% down. I've shown so many clients that maybe 10% down, take the other 10% and get rid of other debts, keep it in savings, get rid of other expenses that's cost you more per month than putting the 10% down. I'm amazed at how many times I'll get clients that'll send me an email or a text saying, okay, give me a loan amount payments at 400, 405, 410, 420. It's amazing how small that is on a mortgage. I mean, you're talking $20, is the differences. Where when you think of a car loan at 20 grand, you're talking a couple $100 difference. But with mortgages, it's not. So saving that 10% down, saving that 50 grand, get rid of all the other debts. So all you have is a home loan, or maybe a home loan and a car loan. You may be better off putting less money down. But that's part of my job, is to just review those numbers and show clients other ways to do it. But working with down payment can really be a benefit and really can free up your buying power and get rid of your other debts, so your overall budget is a lot lower. So it's definitely worth running the numbers in many cases. All right, let's see what else we got. Ooh, how do I choose a credit restoration agency? Reviews. You really want to look at these companies. You also want to be careful of any debt consolidation companies versus credit repair, because debt consolidation is essentially using a Chapter 13 to restructure your debts without going in front of the courts or going in front of the judges. So I've seen a lot of people that go into these services thinking they're saving a bunch of money on their credit cards, and some of the ads even are a little bit fishy or scary, not scary, but they're kind of fishy on how the credit card companies don't want you to know that we can take you from 20 grand to 10 grand, but they're basically using a bankruptcy. They're basically using a Chapter 13 bankruptcy laws without actually having to go in front of the judge. So it just trashes the credit in so many ways. These debt consolidation companies will actually damage your credit. And that's different than a debt consolidation loan. That's different when you're using a bigger loan to wipe out a couple other loans. That's different than a debt agency where you're making your payment to them. They kind of build up that money and then go and lump sum payment to creditors and let everything go late and 30 days late. And there's a lot of stuff that happens with debt management or these types of companies you want to be aware of. But when it comes to credit restoration services, you can do a lot of those things on your own. You can write the letters, you can dispute the things that are hurting your credit. But I find that hiring these companies can be beneficial. I use one called Credit Unlimited. They're out of Bountiful, Utah. They've done a great job, very similar to kind of Lexington Law as far as their pricing and what they do, but they really do follow up with their clients. Their dashboard, I think, is a little bit better, and they really do kind of encourage getting things cleaned up to get you off their program, where a lot of these, they just keep collecting your $50 a month, your $100 a month, and nothing ever happens. One tip I can give you, if you are going through credit restoration services and you get something in the mail that's a reaction to a dispute, where they basically say, yep, it was verified. They send a letter, and then you don't do anything with the letter. You want to get that back to the credit restoration company so they can either dispute it again or move on to something else. I've seen times where it's like 2 or 3 months where the credit restoration company didn't get any updates, didn't get anything from you that showed that what happened with their disputes, and it just sits there and you just keep paying the monthly fee. You don't want to be in these things forever. The idea is to get you credit restored to where you can get a car loan, a mortgage loan, whatever it is. You want to get off those programs as quickly as you can. So you want to have that communication. When you get anything in the mail from the credit bureaus, get it back to either your, sometimes they call them caseworkers, or get it back to the person that's helping you restore your credit so they can either dispute it again or move on to the next thing and dispute that one instead of just letting it sit there for months and months. That's probably the biggest reason people get stuck in these things is they just don't follow up with what happens in the mail. All right, how we doing on time? We're about 30 minutes here. We'll just keep rocking and rolling. Why not? Having too much fun now. Let's see. Can I become a loan officer, a mortgage loan officer with bad credit? Depends on why it's bad, and depends on if there's bankruptcy. It depends on if there's any felonies and stuff like that. So generally, there is going to be a minimum credit score that they're going to pull. They're also really looking at the history to see if you mismanaged your budget, mismanaged your assets, those types of things. So there is some requirements with it, mostly to make sure that you're not um, bad with your finances, and now all of a sudden you're getting all the financial records of other people. So there is a requirement there to review that. If there's bankruptcies, foreclosures, that type of thing, they're going to review that and make sure that that isn't a history of handling your finances bad. Now all of a sudden you're going to be handling financing, giving financial advice to people in the mortgage business. So there is a check for that for sure, but I don't think there's it may have changed. I don't think there's like a minimum credit score you have to have, but there is some history they're going to look at, and they're going to want an explanation for bankruptcies, foreclosures, fraud, that type of stuff. Obviously, they want to make sure that that's not going to be an issue with you handling those documents of other people and giving them advice about this sort of thing. So it's really, really crucial. Is it a good time to refinance a mortgage with a 15-year rate? Again, depends on how much you're saving. I'm not a huge fan of the 15-year term because it is a lower rate, but it's not as much as it used to be. It used to be a bigger gap between a 15-year and a 30-year, and it really hasn't been that big of a gap. And really, it forces you into that payment every single month, where if you just make the 30-year and make the extra payments, you'll get about the same groundwork. But if you have to fall back on the smaller payment during the holidays or something pops up, you're not forced into that 15-year payment. You can go back to the 30 if you need to. So I think having that flexibility, having that cash flow, I think is more valuable than just forcing into a 15-year term. And what you can do is take the 30-year payment, pay the 15-year payment to yourself. So you're building up your interest, you're building up your account. So it's actually earning interest on top of the money that you're doing. You'll actually have your house paid off faster using that strategy than just going to a 15-year term. Now, it does depend on the rates you're getting and the risk of the money. And I mean, obviously, there's some factors in there, but almost every time I've run the math on almost every scenario, having the 30-year payment and paying the extra to yourself or putting in an account, emergency fund, that type of stuff, you're going to be better off in the next 15 years than just putting it all towards the mortgage. So that's a big, but if you're looking at 15-year because you're trying to retire in that window, it is a good time as long as those interest rates are better than what you have, of course. And they should be if you're going from a 30-year term to a 15-year term. Let's go to the real estate section, why don't we? Let's switch over to kind of real estate in general. See if there's any fun questions in here. Oh, this is interesting. I haven't seen this question in a while. What is a short sale mortgage and how does it work? There's really not a short sale mortgage. A short sale is selling your property for less than what you owe. So you're short on covering the mortgage, but there really isn't a short sale mortgage. There's not like a mortgage that is called that. So, and it's interesting. It was just posted. We saw a lot of short sales when values had dropped and people had better interest rates than what they currently have. So they just walked away, or they were able to sell the property, but not for what they owed. So the bank basically had to take the difference as a loss. Now, a lot of times what would happen too is that loss would end up being the tax bill that the IRS, because the company would write it off. So then the person would get a tax bill for what was written off, or it could still be a judgment. They could still go after them for that shortfall. But during that 08, during that whole crisis, there was a lot of loans that were forgiven and a lot of money that was floating around with bailout money, all kinds of stuff to try to keep people in homes or get them sold and kind of get the market moving. But I haven't seen a short sale in a while because most people have equity in their home. I don't see a lot of people that are upside down because home values have steadily gone up or really up, especially with the people that have the lower interest rates, that we really haven't had the need of a short sale market in quite a while. And you're not seeing record defaults, notice of defaults. You're not seeing those types of things that are leading into some sort of crash in the housing market because supply and demand is still a major issue. And the reason why supply and demand is such a big issue is the builders don't build more than what they have to. They're kind of building as they're coming in, and existing home sales are really low because most people can't replace the home or their payment more likely to what's available today. So they're staying in their homes a lot longer than they used to. So the existing home market is really, really soft. There's just not a lot of homes that are for sale that are existing. Most of the homes are some sort of new construction, or somebody has to move. I mean, there's still people that have to move, relocate, downsize, death in the family, divorces. There's always going to be a market for that. But I don't think I've seen the existing home market in most areas as low as it has been, because the people that own that home right now, they have a 4% or less interest rate in many cases. They only owe 300,000, and to replace their home, they have to jump to 500,000 and a higher interest rate. So they're just not selling. They're just going to stay in their home. And that's why you're seeing home equity lines of credit kind of increase a little bit, because they have equity and they have other debt and they want to do home improvements or make the home last a little longer because they're going to be in it a little bit longer. So you're seeing that they're getting access to the equity by doing home equity lines of credit. So I don't see a lot of short sales kicking up anytime soon because they can just sell it. They don't have to short sell it. They owe less than what the home's worth. They can just sell the house. How are we doing on time? Let's see. Okay. How much loan against property can I get? Interesting phrasing. Okay. How much loan against property can I get? It depends on the type of loan. If it's a purchase, it's going to go off sales price or appraised value and usually require some sort of down payment. If it's a refinance, it depends on the actual value now versus what you already owe. And most refinancings are going to be up to 95% of what the home is now worth. And depending on also the use of the loan, if it's a cash out refi, it's going to be a little bit lower. If you're pulling out extra cash on top of the loan balance and loan fees, they do allow you to go up to about $2,000 back and not be considered a cash out refi. But in many cases, people are pulling out more than that if they're looking at some sort of refinance. And that usually caps around 80%. I've seen 85%. But most refinances that are cash out refi are going to be under 80% to avoid adding mortgage insurance or something like that back on the loan. So how much loan can you get? It depends on the loan, the type, the occupancy, a lot of different factors on how much you're going to get a loan for. And that's, again, part of my job is to say, okay, what are you trying to do? This is what you qualify for. Here's your new terms. Does that make sense? Is it a make sense kind of deal for you? And if not, then they don't refinance. So, but definitely a lot more refinance questions. It's interesting to see as the news has turned a little bit, the rates are lower, 14-month low or something like that. And they actually were that for like a day, and then they just ticked up just enough to where we came off those really low parts, but it's still enough to where people are starting to ask about it. Let's see. Oh, excuse me. Who is eligible for a buy-to-let mortgage? Buy-to-let. I have no idea what that is. Okay. Buy-to-let. I don't know. That was posted on Thursday. Last Thursday. Okay. I don't know. Maybe that's in another country. Maybe they have something like that. I don't know what that is. All right. What is the minimum credit score required to buy a house in California with an FHA loan? So they don't really have a minimum credit score, but investors want to see a minimum score. But 580 is kind of the minimum that most investors are going to have, and that requires the 10% down. If you can get to 620, most of all the FHA loan programs kick in. 660, you start seeing some other tiers with different investors that do FHA loans. So FHA doesn't loan the money. They set the guidelines. They set the insurance rates, that they protect the investors, the lenders, that if they follow the guidelines and the loan goes bad, that this fund covers those losses in the event of foreclosure. They'll even sometimes take back over the home and handle the foreclosure process as part of the FHA insurance. So really, FHA is a mortgage insurance company in a lot of ways. It's government backed, but it collects the fees on all the FHA loans that go into this fund to manage the in case of foreclosure. So I always say that it's not hard to get to a 620 score. It really isn't. It takes a little effort. Knowing why your score is the way it is will help you to get the score up over that 620 tier. If you get to that, a lot more options are going to open up, less money down, better interest rates in many cases. 660 is kind of the next tier. So it is something where knowing why your score is the way it is can help you get to 620. It doesn't take that much. It really doesn't. Now, if it's totally trash credit, it might take longer, of course. But I see so many times people are asking, how do I get a loan with bad credit? When I often say, how do we get your credit score up so you don't need a bad loan or a worse loan than what's available? When it's not hard. It's not like you need a 900 credit score to get a mortgage loan with 100% financing. You really don't. But if you get to that 620, a lot of things are going to open up, and it's worth the effort to do that because it'll just give you better rates and terms, less money down, and be a better loan, and your buying power will go up. Instead of only being able to afford 200,000 or 300,000, maybe you'll be able to afford more because the rates and terms are better, the down payment's less. It's just worth working on the credit first. But it takes time. So the sooner you get started, the sooner you're going to be into a house for better rates and terms. Or if the property pops up on the market, you're already ready for it. The last too many times people will wait till their lease is going to expire, have their head buried in the sand because they know their credit was bad since they were a kid and didn't pay a cell phone bill or turned in equipment or student loans that didn't get paid. I mean, there's all kinds of stuff that happens when we're dumb and stupid and don't know any better. And all of a sudden we try to pull our head out of the sand and I want to buy a house. And they think it's going to take 2 months and they'll be ready. It does take some time, but it's very doable. It's not crazy hard to get to those minimum credit scores. So let me work with you on that. Regardless if you're doing a loan in Utah, Nevada, that's where I'm licensed. I can help you review your credit, show you what to do to get on the path to home ownership and why the scores are the way they are. So I'd love an opportunity to help you with that. Reach out to me at ryanbolton.com and we can get started with just even a free credit review. Ooh. Oh, this was 3 years ago. I wonder why that's still in this feed. I wonder why this is still here. Last followed up 3 years ago. How much over asking price should I offer on a house? Wow, times have changed. How much over asking price should I offer? That was the thing that was so crazy about where the home prices were. It wasn't like the prices were set wrong. It was just somebody was offering 4 and then somebody came in at 410, 420, 440, 475 because rates were so low and people were trying to move out of certain areas and shutdowns and everything that happened. So it wasn't like people were pricing the homes out so high. They just got way more than they were asking for, especially in certain price ranges because there was so limited inventory. Rates were giving away money and people were relocating to certain areas to get out of California or to get out of certain areas that were just shutting down and their businesses were shutting down and or retiring and they wanted to get out of wherever they were. I mean, it's just crazy, but that's funny. That's funny to see that in the feed here. It's kind of like when you're on your Facebook and, a photo from like 4 years ago pops up like then and now, or where you were. I mean, I think those are really fun. I think it's almost like a journal kind of thing where you're able to see kind of somewhere you were 5 years ago or 3 years ago. But it's interesting to see that question. How much over asking price should I offer on a home? Boy, those days are gone. Why is it a bad idea to buy a house when you're in your 50s? It's not. I still think you're better off owning a home at any age than you are renting because a mortgage is going to be way more consistent than rental. You're going to have a locked in 30-year fixed payment. Even at 50, even at 70 years old, we can't discriminate based on the age. You get a 30-year fix whether you got to be 18 to sign the contract, but after that, there's no discrimination on your age. There's still income, asset, qualification, all the other stuff. But as far as age, there's nothing we can say, no, we can't do a loan because you're 90 and you're not going to live 30 years, not even close. It doesn't work that way with loans. But is it a bad idea to buy a house when you're 50 or 60? No, because at that age, you're most likely not earning the income or have the income potential. You might be retiring. You might be on a fixed income. Why would you want your rent to change every 6 months, every 12 months? Why would you want to be paying into rent and have nothing to show for it? Nothing to pass down to kids or charities or whatever you want to do with the equity that's built over. I think having that consistent payment with a mortgage is way better than rent that can just continue to rise, especially when you're on some sort of fixed income or pension or limited ability to earn income. Why would you want your rent to just randomly go up? I still think you're better off owning a home at any age, but especially as you get older because of that security of that payment. Is it possible to use your own appraiser when getting a mortgage? No. So you have to use a third party. So you can't own the appraisal company. You can own the management company, the appraisal management company, but you can't own the appraiser company directly. And it's something where we do go through a system, even though it's not technically required by law, it's just become kind of the way of best business practice is for us to order an appraisal through a management company who randomly assigns it to an appraiser. So that I don't even know who the appraiser is until the report comes back into my office, unless maybe the homeowner said that, hey, a guy named Carl came to my office today, or Ryan came to my office today, or my home and did the appraisal, then I might know who it is. But generally, I won't know who the appraiser is. Very rarely do I know who the appraiser is till the report shows up in my office, just to keep that buffer between us and the appraiser to make sure there's no coercion or anything like that, that makes sure that there is a separate independent appraisal report. So you can't use your own appraiser when getting a mortgage. You do have to order it through the mortgage company, through their management company that randomly assigns the appraiser. Now, that appraiser could be on the list, possibly, but you wouldn't be able to just go get an appraisal, show up at a mortgage company and say, hey, I got an appraisal here. I want to use it for the loan. Unfortunately, we're going to have to order a new one in many, many cases. Is physical gold a wise investment or real estate? Real estate. I'm in this world. I'm drinking the Kool-Aid. I have my own rental properties. I just think it's better to have the real estate. Now, gold can diversify. That's still part of a diversified structure, but I still think real estate is the way to go. You can leverage it better. It's a place you can live. You can rent it. You can sell it down the road. There's tax benefits potentially with it that you don't get with gold. So I still think gold's important when there's currency issues and when there's just another asset. It's a way to diversify. But I'm still, if I only had gold or real estate to choose from, I'm going to go with real estate all day long. Any questions? Live questions? Anybody watching? I don't know. I don't even know. I'm just live. I'm just having fun with this. Let's see. Are FHA loans allowed for investment properties in California? They're not allowed in any state. So it doesn't have to be just California. So FHA loans are purely for investment only properties. Now, if you own an FHA loan or you own a property that used an FHA loan and you turn it into a rental, that is allowed. So it's not like you have to refinance it to turn it into a rental, but you can't use an FHA loan to buy an investment property in any state, not just California. So no, that's an easy one. FHAs are not allowed for investment properties or even second homes. They're only for primary residences. What's another good one? Can I refinance the purchase of commercial property can I finance the purchase of commercial property for sale? Yes, of course. You can get a commercial loan. You can get a loan on anything, but especially secured assets like real estate, like commercial. So absolutely there's banks. It's not like Fannie Freddie. It's different than residential financing, but there are loans for commercial buildings. Absolutely. My parents had a lien taken against their property, but the home is in my name. Will I have to pay the lien? Yes. The reason they got the loan is because the collateral of the home. Even if they're not the owners anymore, they could pass away. Anything could happen. The collateral for the loan is your credit income assets, of course, to qualify, but the actual collateral is the house itself. The lien is that collateral. So if the loan doesn't get paid or you sell the property or something happens, that lien needs to be paid to release the property. I've had a situation where, yeah, my parents passed away, so the debt just goes with them, not with real estate. That's why you're getting better rates and terms, 30-year fixed money. That's why you're getting the type of loan you're getting is because it's tied to that asset, that collateral that they will get their money back because the property will sell or refinance or something. They're making an investment knowing that they're going to get their money back. So yes, you'll have to pay off the lien even if it's not in your name as far as the loan or the loan papers. If it's tied to that property, yes, you'll have to pay it off. In a divorce, in a death, parents getting a loan, doesn't matter. If it's tied to that property, it does need to be paid off with selling it or if you ever go to refinance it. The debt just doesn't go away. If it did, then the interest rates would be far worse. We wouldn't have 30-year term money. There'd be a whole different type of lending on real estate if it wasn't tied to the property itself. What is the quickest you've ever sold your home? Ooh, there's a good question. Anybody in the comments, you can answer that one. That's a good question for everyone. What's the quickest you've ever sold a home? Ooh, trying to think. I've never had one of those where I put it on the market and sold the same day. You know those stories. I don't think I've ever had that type of situation. But I've had a couple where it was under contract within the first week, and then took 30 days or so to sell. So it also depends on what you say by, when it actually closed or when it actually was under contract, because sometimes it can be a difference. But I've had people, cash, on the market, cash sold in 4 days. I mean, that's crazy rare. I would say most of the time you're going to be in that 30, 60-day window and even longer. I mean, it's going to take you 30 days to market, maybe 30 days to close, and then that contract falls out and you're another 30 days. So it's very rare that you're going to have a completely done, funded, closed, the whole thing in 30 days 30 days from the day you put it on the market. Usually it's going to be a little longer than that in most cases, and depending on the market. But the quickest for me, I think I had one maybe under contract in the first week and then 30 days later. So that's probably the quickest I can think of off the top of my head. But maybe you've got one that's quicker. Maybe you got one of those success stories. Another one, what's the longest it's ever taken? Yeah. All right, let's see. Oh, this is kind of an interesting one. If I sell my mortgage-free home, so it's free and clear, do I have to use 100% of the proceeds to buy a new home? No, absolutely not. So if it's in a 1031, if it's an investment property, there may be some capital gains you have to worry about. But if it's a free and clear primary residence, you've lived in it for 5 years, whatever it is, and you sell it and make 300,000, 500,000, whatever you make it, you don't have to take all of it and put it down on a next home. So the answer to that's no. That's actually kind of a good question. You can put 10% down. You can do 100% financing on the next house, even with all the money in the bank if you wanted to. So it's not something where it has anything to do with the new purchase. There's benefits of why you would put some money down or not put money down or pay off all the other debts. But the answer to the question is no. If you sell a free and clear home, you don't have to take all the money and use it to buy the next house. You just have to put minimum down, whatever down payment that makes sense for the loan that you're trying to do. If it is an investment property, you may want to look at 1031 exchanges to then take that money and roll it into the new property because of some tax benefits and avoiding some capital gains. But if it is a primary residence, no, just keep the money. It's tax free. It's not something you have to worry about paying taxes on. Is this all real estate? Am I still in the real estate section? Yes. Okay. We can stay in real estate for a little longer. How are we doing on time? We're almost hitting an hour. Woo. Wow. There's only been one question that stumped me, and I don't think it's because it was worded right. So, something about buy it, let mortgage. I don't even know what that is. Can't even think of what that could be. How fun. How fun. Nerding out in the mortgage industry. Welcome to Mortgage Nerd. All right. Let's see. Let's go back to this section here. Is it common to pay rent to parents while living in their house? Depends on your age. If you're a 5-year-old paying rent, maybe I'd say, maybe building some good character development there where they have to give you the Reese's Pieces or something for rent. So is it common to pay rent to parents when living in their house? At a certain age? Yes. Yeah. I mean, that's yeah. Go find cheaper rent then. Good luck. All right, what else we got here? Let's see. What's the difference between loans when purchasing a first rental property? Which type of loan is more suitable in this situation? So most rental properties are going to require at least 15% down. I haven't seen anything really at 10%. Most of it's going to be 15% down, 20% down. 25% is where you're going to get a little better rates and terms. There is programs that require income and asset verification. There's programs that just require that the rent on the home covers the mortgage payment. So there's a lot of different programs out there to do it. It just usually requires more money down on investment properties, more skin in the game. There's no mortgage insurance options or limited mortgage insurance options. That's why more down payment is required when it is an investment property. So what's suitable? It really comes down to your down payment requirements, your income assets, what type of loan you're trying to get, how much cash flow you're getting from that rental property versus the mortgage payment. That's one of the problems we have here in Southern Utah is rents are still much lower than the actual mortgage payments because they're still behind the rise in home prices. But that's why you're seeing rent go up. Very few people are seeing their rents stay the same over the last year or so as costs have gone up, inflation's gone up, rents have gone up, and they can just purely rent it for more. So they're going to offer it for more, and maybe their expenses have gone up with the property. So it is something where that's part of reviewing where your situation's at to determine what best rental income, rental property type loan you're going to get. But almost all of them are going to require a higher down payment than a primary residence. Can one buy a house without getting a mortgage with a bank and with zero money down? Without getting a mortgage. A mortgage is a home loan. That's interesting. I see that often where people say, "Oh, I don't want a mortgage. I just need a home loan. I just need a loan to buy a house." That's what a mortgage is. It's the term. It's the term of what a loan is against the house is a mortgage. So no. Can one buy a house without getting a mortgage with a bank and with zero money down? No, that's a mortgage is what it is. I don't know if it's a fear, if they just don't understand what a mortgage is, or home loan is a softer term, more friendly, I guess, maybe. But no, a mortgage is a home loan. A home loan is a mortgage. How are we doing on time? I think we'll go maybe to the hour mark. We're at 53 minutes. See if we can squeeze a couple more. If you have any questions, jump them in the chat. I'll answer those for you. Let's see. Should first-time home buyers consider getting a 40-year mortgage? There's not a lot of 40-year mortgages out, especially first-time home buyers, limited down payment. And it's really not a huge difference. It's amazing how adding that 10 years is like 99% interest for the whole 10 years. It's almost all interest for the first 5 years of a 30-year mortgage. So going out to a 40-year doesn't really lower the payment that much. It's really not worth it in many cases. But and I don't know any first-time home buyers that allow a 40-year mortgage. Maybe they will, and they're not a standard loan. I don't see a lot of requests for 40-year mortgages. I really don't. It just doesn't save. It's amazing how much it just doesn't change the payment that much. Now, maybe on the really big loans, maybe, but even then, for that extra 10 years, almost all interest, it's not really worth it. Let's see. With the home equity, with a high equity in my home, can I pay a lien off with it? Yes, if it's not the lien that's on the home you're doing the loan with, because a home equity line is another lien. So you're not paying off a lien with a lien because the lien's still there. But if it's another lien on another property, yes, you can use your home equity, do a line of credit or a new first mortgage or whatever it is, take that money out and then go pay off the other lien against the property. But if you're trying to pay off the lien on that house, a home equity line is a new lien that's replacing that lien. So if that's what you're trying to do, you can. But again, this is one sentence, 15 words there, or whatever it is. So it doesn't have all the nuance within, kind of the terminology may be different. But if you have a lot of equity in the home, if you're trying to pay off a lien with it, then you're just replacing it with a new lien. That's basically what a refinance is. It's refinancing the old loan terms and replacing it with new, better terms, ideally, or cash back or some other reason why you're doing a new loan. All right, let's see. What else are we going to do? Should we jump into something fun? I don't know. This is fun. Hey, this is fun. I think it's fun. I mean, that's why I like N3rd now. Let's go back to mortgages. Let's see if there's anything specific mortgage. Oh, I wonder if credit's in here. We ought to find maybe questions on credit, but let's try mortgages here. Bum, 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 bum. I'm trying to refinance my home. Come to find out I have a state lien for about $3,266. That's specific. Can I still refinance? Yes. That would just most likely have to be paid off as part of the proceeds of the loan. So it would be something that would have to be factored in. Either have to raise the loan amount to cover it, or you have to bring that cash in to not have to pay for it through the proceeds of the loan. That might trigger a cash out refi. So you may have to pay a higher interest rate to pull out the money to pay that off. So you just have to look at the terms, but it wouldn't prevent you from refinancing just because you have a lien, a state tax lien, office recovery services like child support, HOA lien, the first and second lien, wouldn't prevent you from doing the refinance, other than if all those add up to more than the loan amount can be, then you have to come up with cash to pay off those things. So it can restrict your ability to refi, but it wouldn't prevent it just for that lien alone. There may be other things that would trigger, but it wouldn't be a prevention from preventing you from getting a refinance done. That's a good question. I mean, yeah, that's good. Should I refinance my mortgage now that the average rate of 30-year fix has fallen to 6.55%? This was posted August 15th. So, okay. Depends on what the rate you have is now. Depends on how long you're keeping the home. Depends on if it's cash out or if it's paying off first and second. There's lots of depends on this particular question. And it really would come down mostly to what rate do you currently have. Do you have mortgage insurance? Then it would make sense. But just because it's 6.55, if you're at 4.55, probably not. If you're at 8.55, absolutely. So it really does depend on what loan you're replacing 6.55% with. That will help you determine if it makes sense to do a refinance. A lot more refinance questions. Kind of funny how that works. How are we doing on time? Ooh, we're almost to the 1 hour mark. Time flies when you're having fun. Ha! Mortgage nerd. All right, let's see. How can I determine if someone who owes me money has filed for bankruptcy without hiring an attorney? I don't know. It's a good question. Posted 5 hours ago. How can I determine someone who owes me money has filed for bankruptcy without hiring an attorney? They do have to do public notices. That's a good question. I'm not sure that'd be an attorney question. I'm wondering why that's in the mortgage section, unless it's a mortgage that somebody owes. Usually there's some sort of public filing, that type of thing. But without hiring an attorney, I wonder if that's just online or something, filing bankruptcy. But I thought, that might be a good question for the chat. I think you have to have an attorney, a bankruptcy attorney, to start filing that because of those things. I don't think you can file a bankruptcy without hiring an attorney of some kind. But maybe I'm wrong. How do mortgage advisors compare different lenders? So we have a list of different lenders. We have Fannie, Freddie, all kinds of different lenders that we get rate sheets. We have systems that compare the daily rate sheets that are available through our loan origination software that will be able to compare the daily rates of any particular investor. A lot of the guidelines are set for the type of loan that you're getting, and there's different investors that agree with those guidelines with their shareholders and loan to those guidelines. But a lot of times we're able to get daily rate sheets that are emailed. There's a lot of systems that report those into these aggregators that just have all the information together. We can tie into our loan origination software, and that's changed a ton. I remember early on this, I've been doing loans since 1999, and we'd get email rate sheets and just have to compare them. We'd print them off and have these sheets where we'd go through and see kind of what the different rates were. And then we get faxes. Faxes, wow. We get faxes or notifications. There's a midday rate change that because the market's going nuts or something, and they'd have to adjust those rates. Then email came out, and that's really what all these emails would come in. We have these daily rate changes. All that's got automated. All that's kind of been built into these software systems. They've all been kind of reporting to these systems that we're able to update on a daily basis. And rates can change, just like stock prices. They can change daily. Some lenders change a lot because their margins are different. Others are, kind of need to see a big movement. That's when you don't see too many. I remember one time there's like 7 rate changes in one day. That was bonkers. I mean, I just could not believe I saw that many on just like normal rate days. I mean, there's some lenders that'll change every hour, you know what I mean? But that's just what they normally do. But very rarely do you see kind of a midday rate change. They post the rates in the morning, kind of open the stock market within an hour or so. And they usually stay that way unless there's a big change to the interest rates in the middle of the day. And you might get one change, in a day. But I remember it was bonkers. I mean, it was up and down. It wasn't like it was just all up or down. It was just kind of, the market was going nuts. It was just, I remember it was like 7 in one day. It was just nuts. All right, what else we got? Let's see. Oh, we hit this 1 hour mark. If you have any questions, please comment. If you can hear me, hopefully you can hear me. Post it there. We'll post the video later. Let's see if we can finish off with one more question here on the mortgage nerding out. Ooh, this is going to take a while to answer, but how do I update a credit score? How do I upgrade? How do I upgrade a credit score? So there's really 5 things that factor into your credit score. One of the best ways to improve your credit score is balance to limit ratio on revolving accounts. So a revolving account is a Visa, a gas card, a store card where you can use it, pay it off, use it, pay it off. Has this revolving feature where it can go up and down. 30 to 35% of your credit score is based on what you owe versus what the card is worth. If it's under 30% of the limit, you'll see a boost to your score. Now, I have people tell me all the time, well, I use it, pay it off, use it, pay it off. But what you want to do is when they go to report, which is usually only once a month, you want that balance under 30% of the limit. You'll see a big boost to your score month over month if you're able to manage that balance to limit ratio. And history is a big part. Lates, collections, you want to take care of those. But there's nothing like month over month that can be faster to improve your credit score than how you manage revolving accounts. And that is spread out over all your accounts. So if you have only one credit card, all of that algorithm is based on that one credit card. So it's usually good to have up to 3. I don't recommend more than that. And I don't recommend trying to borrow more than what the 30% if you can. But these are ways you can help build your credit. So let's say you have a $5,000 credit card and you're always using about $3,000, paying it off, $3,000, paying it off. You may ask the credit card company to raise the limit a little bit to give you a little more room so you do see improvement in your credit. Now, I always caution, don't just raise your limit and then start spending more. You don't want to raise it from 5,000 to 10,000 and all of a sudden you start spending $7,000 a month. So there's a balance between what's good for your budget, what's good for willpower, what's good for your life, and what helps your credit. But that's one of the best ways to improve your credit score. There's a lot of other ways, but that's one of the number one ways when I'm sitting down with a client. Okay, let's get these credit cards paid down before the billing cycle. Let's update that cycle and you'll see a boost. I'm amazed at how many times I've been able to raise credit score, especially when they only have 1 or 2 credit cards, because all the weighting is in those 2 accounts. If they always show maxed off, even if they're paid off that very day, you get the bill, you pay it down to 0. So you're not paying interest, you're getting the points and rewards. That's great. But they only see it once a month. So whatever's on your statement is what they reported for that month. So then you pay it off and then you slowly use it for the next 30 days. They report it again and you're back up to over 30%. So it's really the best way to improve your credit score is managing revolving accounts. Anything that has a draw feature, use it, pay it off, use it, pay it off. So PayPal, Old Navy, Gap, anything that has kind of a credit feature where you're able to pay it, use it, pay it, use it. Credit cards are a big one, obviously. Overdraft accounts, that's another one. Gas cards, trying to think of anything else that just has that line feature. Their visas or revolving accounts. That's really a big part of what your credit score and how to improve it. All right, let's end the stream. Thanks for being on. Thanks for watching. Whenever you watch this particular stream, I really enjoy answering questions about the mortgage business. If you need help, I lend in the states of Utah and Nevada. My office is in Southern Utah, and we do have other loan officers within our company, Patriot Home Mortgage, that are licensed in other states. So if you just need some help, some advice, that's what I'm here for. I don't have to do your loan directly. I love giving advice. I love helping with this industry. I've been doing it a long time. But obviously, I'd love to earn your business. If you need help or just a quote or just review your situation, review your credit, trying to buy property, refinance, whatever it is, I'd love to earn your business in Utah and Nevada. Check out my website at ryanbolton.com. It's got my licensing, NMLS number 299717, equal housing lender. I got to have all those disclaimers and all that, but it's on my website. But if you have any questions, please reach out, ryanbolton.com. And we'll see you on the next video. Have a wonderful day. All right. Hope this is